Well, hello everyone and welcome to TradeStation for today's webinar as we are very excited today about this presentation. If you're ready to trade options or you want to expand your options trading horizons, John Carter, the founder and the CEO of Simpler Trading and the author of the best-selling book Mastering the Trade, is going to describe the 5 basic option strategies that he likes to follow. Directional swings lasting a few days, directional swings, directional day trades that last a few hours, selling credit spreads on weekly options, and implied volatility crushes on bad news. Now, Mr. Carter has studied finance at the University of Cambridge in England before graduating from the University of Texas at Austin. He's been a full-time trader since 1996, and back in 1999, he launched his first company, TradeTheMarkets.com, to post his trading ideas. That turned into Simpler Options, and as he has added more analysts and branches, he grew the company into what it is now, Simpler Trading. He built this business and his team because he really likes to inspire other traders. And as the Director of Trader Development here at TradeStation, I want to tell you there's not a better person to help us unwrap this topic of options trading. So I'm very excited about listening to John Carter myself today. As you might know, my name is Don Prattle. I am here almost every day running webinars here for TradeStation, and today is no different. We have some business to take care of. Our important information and disclosures as usual. Remember that our presentation is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are for demonstration purposes only. They are not recommendations. Our presentation is also not an offer or a solicitation anywhere where a TradeStation affiliate is not authorized to do business. Active trading may not be suitable for you because active trading is not suitable for everyone. Options trading does carry a higher degree of risk and may not be suitable for all traders. Because of that, we've posted some very important disclosure information in PDF handout documents I've posted in the chat panel. You can click on them. They'll open in another browser tab for you to read at your convenience. With the business end of this out of the way, let me bring on our presenter today, Mr. John Carter of SimplerTrading.com, to help us understand his 5 favorite options trades. Oh yes. I'm sorry, John. One more little announcement, and thanks, Raffle, for reminding me. We are recording this event, as we do all of our key presentations here at TradeStation, and so it will be available tomorrow on the TradeStation website. If you are a TradeStation account holder, it will be available in Video Station. If you want to go to the TradeStation YouTube page, it will be posted there also tomorrow. So yes, we are recording. We'll have it produced and set in one of those 3 locations sometime early tomorrow. So with that out of the way, now, Mr. Carter, please, the stage is yours.
Okay, Don, thank you very much, and hello everybody. I'll just do a quick sound check and make sure that you guys can hear me okay. It's always a positive, and excellent. And yeah, and thank you. First of all, of course, gosh, I've been using TradeStation for 15 plus years, and it's always great just to do anything with them. I love their charting platform. I love all the tools that they have, and so it's always fun to be just doing something like this. And then also, it's always fun for me to talk about option trading. I trade about everything, but option trading is my favorite because, well, as we'll get into, because there's just so many things that you can do with them. Typically, if you're going to buy a stock or a futures contract, I mean, essentially, you know, if you think something's going to go up, you buy it, and if you think something's going to go down, you might short it. But with options, there's so many other nuances that you can incorporate into your trading. And one of the trades I'll talk about is something we could actually do on Tesla tomorrow morning. I'm seeing after hours it's had some bad news and it's down like $30 a share. And one of the trades I'm going to talk about is called the bad news IV implosion. So when we get to that, it'll be interesting. All right. So let's just kind of dive right into this. So now some of these slides and examples are a little older, but these are all still strategies I'm doing today. So where appropriate, I will, point out, some other trades that have come up like this. But so a quick question for you guys. How many in here, and what I try to do with these things is whether you're brand new to trading options or if you've been doing options for a while, is that you can kind of derive some value from this. And so just out of curiosity, how many people in here you consider yourself really a novice when it comes to options? Like you haven't really traded options very much. So like how many folks are new here? So a couple there. Okay. Yeah, no, that's good. So here's the thing with options, and this is all, and I think my journey in terms of learning options was a painful one because I never really felt I found things that that really made sense. And at the end of the day, there's hundreds of books, literally hundreds of books that are written about options. And there's also hundreds of strategies a trader can do with options. And what it came down to, and I realized in a lot of the books, is what would happen is I would read about all these possibilities that you could do, okay? But at the end of the day, is what would happen is like, okay, but I want to know, of all the possibilities I could do, which ones work the best and when should I use them? And that was something I never really got out of the strategies and kind of had to figure it out for myself. So, so that's the kind of stuff here that we can kind of talk about. So, so from there, the one thing that I think it's just kind of the summary of how stocks move and all of that kind of fun stuff is it's important to realize that about I would say conservatively, and I'm trying to write here with my mouse, 80% of the time stocks are just kind of doing this. If you see right here, they're just kind of going back and forth and kind of back and forth. And then 20% of the time, they might have what I call a concentrated trend move. Okay, and this is important. And for a long time, I thought that these things were just kind of out of the blue. It's like, oh, okay, it happens to be moving now, maybe because some kind of news or something like that. But the important thing to understand is that these trends can be timed. And if you are, let's just go with the basics. So this stock is CMG, right? Chipotle stock. So if you're going to buy the stock and you're just like, oh, I like this company, then, let's say you bought the stock right here, okay? And then you held on to it and, a month later it was right here. Well, you could sell it and make a little bit of money, okay? Now, had you bought call options here, like say at the money call options, and it traded sideways for a month, and even though the stock went up a little bit, you would lose money on that. Okay, so an option essentially is a depreciating asset. It gives you a lot of leverage to participate in a stock, but at the same time, the option price, a lot of that is premium, and that premium portion essentially erodes a little bit day by day. So if you're going to buy a call, the short version of all this, to make money with a call option, you need to be able to time a move like this. Otherwise, it's very, very difficult. Okay, so how I like to time these moves is something called the squeeze. Now, this is something that created a long time ago, but I use it on all of my charts even today. And what this does, it just measures the Bollinger Bands when they get really narrow, okay? And when they get to a certain spot, essentially what happens is they can't get any more narrow. And if they can't get any more narrow, then they have to expand again. So I'm looking for moments in time when the Bollinger Bands can't get any more narrow, and then they have to expand, and that's when I want to time my option trades. All right, so that's the kind of the first thing that I want to point out as that concept is just 80% of the time, stocks are kind of going back and forth, and if you're buying calls or buying puts, that's like the worst time to get into the markets. But 20% of the time, they're going to have a concentrated move, and that's where directional options trading really shines, okay? So the other thing that we want to talk about, and one of the great things about options is there's a lot of math that you can use to help you out. Now, I'm going to be the first one to tell you that there's a lot of math and Greeks involved in options that I don't look at all. So you hear things like Vega and Gamma and Rho and all this kind of stuff. I actually don't really look at that stuff. But implied volatility is useful for a couple of reasons. Now, all this stuff here, don't worry about it. This is just if you're interested in it, this will be recorded. You can view slide 6 and say, oh, how does this work? I always say it's like electricity. I don't really understand how electricity works, but I know when I plug in my iPhone charger, it works. Okay, so how is IV useful? So what happens with implied volatility is that the market makers are very, very efficient about pricing options. Okay, so essentially what they do is they price the options that, here's the standard deviation. So if you wonder why, like say Apple, the Apple call is say $3, okay? Well, this $3 price is based on the statistical probability that it's going to trade within a specific range, okay? And the market makers have all of this information to do that. And guess what? 70% of the time, they're right, and it does trade within a specific range. And what's nice about this is that we can use this information to figure out what the potential move is. All right, so what I like to look at here is just say like, okay, and this is all stuff you can look at in within the TradeStation platform and see, but it'll tell you literally if Netflix, the current price of Netflix is $260, and let's see, if the current price of Netflix is $260, right, and there's 40% implied volatility, well, it'll tell you then that it's it's essentially the options are pricing in a $9 move. So guess what? If you get into Netflix and it moves about $9, that's about all you're going to get, because there's going to be market forces that actually try to keep it below that, so the market makers can kind of keep their money. Okay. So that's kind of the first thing to understand, is that I never like to say that the game is rigged, but 70% of the time, prices will trade within what I just call their expected move. All right, and that's why the implied volatility is important. And all right, so how this works is you'll look at if you look at the options. So you can see here that here's an option that's 13 days out, right? So this option here expires in 13 days, okay? But this option here expires in 48 days. So if you look at essentially, with the implied volatility, it's saying, well, over the next 13 days, they've priced in a $25 move, and over the next 48 days, they've priced in a $47 move. So the short version is that if you get into these September calls, and the stock does rally $47 from your entry, get out, because the odds of it going any higher are very, very low. All right, so I found that just very helpful in knowing kind of when to get out. So, and again, that's probably the most complicated part of anything I'll show you today. And if you're newer, don't worry about it too much. I just kind of always like to kind of expose, expose this idea, just to kind of the idea that these ranges for a lot of stocks are actually predetermined in advance. All right, so it just kind of makes it interesting. So a couple things that you can do with this is that sometimes I'll just draw these on a chart, and you can just see like, okay, well, if Chipotle, here's the one standard deviation move for this week's options, and here's the one standard deviation move for next week's options, and then the one standard deviation move for the monthly options, and you can just kind of see where they are. And so if you have the monthly options and the stock, gets up to here, guess what? Don't get greedy, because that's about all you're going to get. So, you get out and move on. So I find that a very useful tool. So now what I do then is I look at what that expected move is, okay, and then I look what that expected move is, and so I'll sit there and say, okay, we get a squeeze, those red dots that we're looking at, okay, that's a good entry. And then I'll look at the expected move, and if the expected move on Chipotle is like $25, then guess what? If the stock takes off and it goes up $25, I am very, very clear, because a lot of times when people look at targets, they'll do support and resistance and all these different things, and that's great. But the real reality is that these price movements are being driven by these implied volatility calculations. And so if it does go up $25, right, you might have some resistance here at $10. Well, don't worry about that. Look at this $25 level from your entry, and when it gets there, feed the ducks, okay? Don't get lost in these fantasies that, oh my God, this thing's going to go higher. Yeah, and it might, But there's a 70% probability that this is all you're going to get. And guess what? It's plenty. So I always say with options, don't focus on those pie in the sky moves. I mean, look, I'm the first one to say I love buying options at 2 and selling them at 10, right? But the bread and butter trades in directional options are you're buying stuff at, buy options at 3 and sell them at 6. Buy options at 6, sell them at 10. And you can do that over and over and over again if you get the timing right directionally with a squeeze, and then you know where the targets are that are already baked into the market. All right, and this works to the upside or to the downside. So that's the kind of stuff that I find pretty fascinating. Because what happened a lot of time too, and I always say feed the duck so you are the duck, is that a stock will rally into a level and people get greedy, or worse, they actually start buying it here at the top, right? So that's the worst. So if you see a stock that's up like $20 on the day, guess what? It's already made its expected move. The odds of it going much higher are pretty low. So then what happens is then it starts to roll over and it starts actually selling off pretty hard because of all the stop losses. People all have their trailing stops and all that kind of stuff too. So sell into that strength, but you got to know where the odds are that that move is going to peter out, and then that's how you do that. So George, how much do you sell the squeeze indicator for? You can actually try it for free on TradeStation. And so if you go into the App Store, I think there's like a 30-day trial where you can just try it out and you can play around with it and see if it's something that you like. But I think it's a fairly reasonably priced indicator. So strategy number 1. So knowing all that, strategy number 1 is directional swing trades that last a few days to a few weeks. So the main thing is, so one thing here, and this is something that one of my mentors told me a while ago, but he told me that, and I'd like to day trade and stuff like that too, but he told me to stop looking at any charts that were under 30 minutes. Okay, don't look at the 1-minute charts, don't look at the 5-minute charts. And at first I thought he was kind of crazy, and I was like, I love looking at those charts. He's like, they're not helping you. So I was like, fine. So I tried it for a month, and my trading did improve. And so with swing trades, what I'm looking at are daily charts and above. Okay, so I'm not worried about what's going on a 5-minute chart or anything like that. So what I'm looking for, though, is that I have a squeeze set up on the underlying stock on the daily chart. Okay, so one that we're in right now that's been really a lot of fun is LGND. So it's got a nice daily squeeze, and it's starting to pop out. And those are the kind of things that I like to look at, where a stock moves up, it's consolidating for a while, it builds up a squeeze, we get our positions, and we look for the next leg higher. And the other thing is which option do you buy? Okay, now the biggest mistake I see newbies make is they look at the options and they may see, like, so look, let's say a stock is $100. Okay, so they'll look at the options, and so there'll be like you can buy like the $95 strike, the $100 strike, which would be at the money, or the, let's do this one over here. I'm running out of room. The 105 strike, okay? So the 95 strike, again, remember the stock's the stock's $100. So the 95 strike might be $8, the $100 strike might be $4, and the 105 strike might be $2. And so what happens with newer people, they look at this and say, well, this one's $8, this one's $4, this one's $2. I'm going to buy the cheaper one because I can make a lot more money there. Well, that's the sucker bet, okay? Again, we go back to the expected move, and the odds of it getting to 105 are kind of low. I always go in the money. So typically what I'm looking at is a delta of 70 or higher. And that's typically what that means is 1 or 2 strikes in the money. So if the stock's a $100 stock, I would much rather buy, say, 2 contracts at $8, versus 8 contracts at $2. That's the higher probability bet, all right? That's a huge thing, and newer people often get caught up in buying the wrong options, which can lead to a lot of problems. So here's an example of MasterCard where you have a squeeze, okay? And again, instead of buying these way out of the money calls, you buy them that are in the money, and then you participate in that price movement. So I always just think of it, look, instead of shelling out $200 for the stock, yeah, you're just buying options for $8. So you're saving a lot of money already. Just make sure that you're buying options that are actually going to work, okay? So, and I'll also say the other thing here is give yourself the gift of time, okay? I like trading weekly options, but if I'm going to do a swing trade, then, are you going to buy an option that's going to expire in 5 days, or are you going to buy an option that expires in 30 days or 60 days? Always give yourself the gift of time when you're buying options. Even if I plan to be in a trade for only a couple of days, I typically will buy an option that's 30 days out or more. And the reason for this is because the premium decay is so slow on this compared to an option that's going to expire like in 3 days. Okay, so if an option expires like in 3 days and the stock's still trading sideways, you're going to get killed. Whereas if the option expires in 30 days, you're not going to lose that much premium. All right, so again, think of it as give yourself the gift of being in the money, okay, and then give yourself the gift of time, and you're going to be ahead of 90% of all the other newer option traders out there. All right, so, and yeah, and typically what I like to do is, we talked about the expected move, but also, if I buy an option at 4 and it goes up 50% to 6, I'll typically take off half and move my stop to break even. And that's just a good money management strategy as well. And then for the squeeze, what I like to do is hold on to a piece of the option through the entire move. So here's the red dots, right? And then you just kind of stay here in the momentum trade, and then you'll notice here that once it loses momentum, that's when you exit, because at that point the squeeze is over. So a squeeze starts with the red dots. You buy your in-the-money calls. You can ride it as long as the momentum's going higher, but once it loses momentum, you just get out, okay? And then you just stay out of all the choppy mess. And so that's a part that I really like about it. So in this case, even if the option is quote unquote expensive, like these in-the-money options were $17, but you're selling them at $55, all right? So in this case, one option at $17, because it represents 100 shares of stock, it's going to cost you $1,700. And then you sell it at $55, so you sell it for $5,500, and then you keep the $3,800 per contract. Now there's ways to lessen your costs if that's too high a price for your account. If you're trading a $2,000 account, you don't want to bet it all on one trade, but that just kind of gives you an idea of the profit potential. The other thing I like about the strategy with the squeeze is that you naturally want to buy options when the implied volatility is low. And again, you don't even have to understand this. Just know that when you're buying options, when there's red dots, the implied volatility actually drops during that time. And then when the squeeze fires and price accelerates and gets more volatile, guess what? The implied volatility rises. So what I love about this is that as implied volatility rises, the premium portion of the option also becomes more valuable. So it's a double whammy in your favor because your option is increasing due to the underlying price rising, but it's also increasing due to the implied volatility rising. It's like a win-win. So it's one of the things I love about the squeeze because you're buying, you don't even have to know what you're doing, but you're buying when the implied volatility is low, and then the implied volatility accelerates after you get into it, which is fantastic. Okay, so that first strategy was strategies that last a couple of weeks. So what about swings that last a few days? Well, the beauty here is that you are doing the exact same trade, except instead of using daily charts, okay, so a daily chart typically is going to last a couple of weeks, you just drop down and use like an hourly chart, okay? So same idea. So instead of looking for squeezes on the daily chart, I'm just going to look for squeezes on the hourly chart. It's typically a trade, like if I got in there on Tuesday morning, then I'd sell it like Wednesday afternoon or Thursday afternoon. All right, so it's a nice kind of a shorter term trade. Now, the one thing I will say here is that, yes, I take it off the hourly chart, but I want it to be in alignment with the daily chart. Okay, so what does that mean? That just means that, all right, so here was a chart. Here's a chart of Goldman Sachs. So we've got a squeeze, okay? You can see that price you know, price had been trending higher. I just want to say like, okay, now what about the, you know, what about the daily chart? Well, the daily chart's also in an uptrend. All right. So the important thing here is that if the hourly chart you're playing, so you look at an hourly chart and it's trending lower, and so you're going to try to short it, but the daily chart is trending higher, well, that's just your, you know, it's just like crossing your wires. So the easiest way to have an easy life trading, and I say easy life, just, you know, I always say, like, look, if 75% of your trades are winners and your winning trades are bigger than your losers, then you can do this for a living. It's not that hard. The hardest part is just people get screwed up in their psychology. It's like, oh my God, I gotta, you know, I gotta try to make more and blah, 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 blah. But if you just say, if as long as you're patient and wait for trades that are in alignment, so you're looking at an hourly chart, well then look at the daily chart. Is it trending higher as well? Yes, great. So that's just it's an important, simple yet very important. So in this case, again, I want to go in the money, even though it's for a couple of day trades. So in this case, the stock was at like 150. So the 155 or 160, the 155 calls had a delta of 68, again, which is close enough to 70. Now, if I say delta and you're like, John, I don't even know what you're saying, don't worry. Just remember, if you're buying calls, you want to buy strikes that are below the current price. Okay, if you're buying puts, it's the opposite. So again, let's say the price is 100. If you're buying calls, you want to buy in the money calls, so below current price. If you're buying puts, then if you want to be in the money, you just want to buy puts that are above current price, i.e. in the money. Okay, so the 105 puts would be in the money, and in this case, the 95 calls would be in the money. So that's just the main thing there. So in this case, you know, for stop losses, I typically will just use average true range. So the average true range in Goldman Sachs was $1.03. So I just like to take that and double it. And that way my stop loss is $2.06. That way you're just out of the noise. If you take the average true range and multiply it by 2, you're out of the normal day, you know, the normal grind. Okay, you don't want to get stopped off on what I would call normal grind stuff. So in this case, on those hourly charts, typically what I'm looking for here is that a stock that can move around 1.5%, okay? In this case, if the stock moves 1.75%, which for a stock is not a huge move, but guess what? For the option, it is a very big move, okay? So essentially in this case, if the stock moves $2.82, my option is going to move $1.97, give or take. All right? And so on stuff like that, again, this usually typically what you're doing is if the underlying stock is going up 2%, your option is typically going up 60, 70, 80%, all right, which is great. John, using what length to compute average true range? So the default is 14, which is fine. Sometimes I'll use the 21, but they're not that different. You don't want to use less than 14, but you know, 14 gives you a nice, good, you know, nice solid thing there. Okay. Yep. All right. So strategy number 3 now. So we talked about strategy number 1 was trades that last a couple of weeks, you know, directional, essentially squeeze off of the daily chart. Strategy number 2, trades that last a couple of days, directional, hourly chart. So what about directional day trades that last a few hours, if you like to do that kind of thing? So this is something where what we're looking for very specifically is a stock that's been kind of, you know, say moving, like, you know, it's been trending higher, okay? And I'm using bullish examples just because the markets are trending higher, but it works the same with bearish as well. And so what'll happen on something like this is then, you know, as it's and then it'll pause, you know, and it'll pause, and then you'll start getting those red dots, and that'll form a squeeze. And what you're looking for essentially is the next leg higher. Okay, so your target with this is a 1272 extension, and I'm a huge fan of the 1272 extension. So what does that mean? I think I've got a slide on it, yeah. So if you're familiar with fibs at all, essentially, so here's a swing, right? So here was the high and here's the low, And now, we're approaching the high again. So what's the 1272 extension? Well, literally, and you can go into your fib tools in TradeStation and just add this in here. And I mean, literally what you're doing is if a stock takes out the prior swing high, I have found that it has about a 90% chance of testing its 1272 extension of this move, okay? And of course, all that is essentially taking, about 27% of this move and just projecting it above current price. And that's essentially, and sometimes it'll go to the 1618, but this is the high probability move. So if I'm doing some kind of a day trade or anything like that, that's like one of my favorite targets. It's a pretty quick one. Is this only good for version 9.5 as noted in the store, or will it work with version 10? So Dennis, I'm assuming it'll work with either one, but I don't know that for sure. So I could check, and Don might know, but we could double check. But I'm assuming that we would make sure that it would, anything would be updated to work with either version. What time frame chart on day trade for the fib extension? So typically on that, I will be looking at no lower than 15, but my favorite is the 30-minute chart. The 30-minute chart is very solid, and you're just looking for essentially the next swing up during that day. All right, so it's good stuff there. So here's an example of MasterCard. So this was one where you can see the stock jumped up after earnings, and it hit a peak right there, and then it just kind of spent the day consolidating. Here we are, it's 10 o'clock in the morning, noon, and we're just kind of consolidating, and then here's the squeeze, okay? So guess what? We get in, we buy some options, and what's our target? From this swing high to this swing low, our target's the 1272 extension. So we're not looking for a lot, right? The stock is sitting here at $383, so we're just looking for a move to $387. But for a day trade using leveraged options, that can turn into a decent amount of money. And so we come in here, and when I'm day trading options, I actually really like to use the matrix. There's actually, and this was more, since I took the screenshot, the option tools in TradeStation have expanded exponentially. But I actually am a fan of this because there's really not any other platforms that you can do this on. And you can just kind of sit there and you can see the bid ask. As the stock's going your way, you can, see your P&L, whether it's positive or negative. But in this case, you can see all I'm doing is I want to see, will this get to here? And here I just have 5 contracts, or 5 left in this. But you can do some pretty decent size on this, and it can turn into a decent amount of money. So on this, you can see we pop up right into that 1272 extension, and you can see that this is turning into like a $25,000 trade. Now, obviously, had the stock fallen apart, that would have turned into a losing trade, right? So this is when I get back to probabilities, probabilities, probabilities. And if you're sitting there and playing blackjack, and you know that you've got a 75% chance of getting a 21, if you guys are familiar with blackjack, then guess what? You keep making your bets every time, every time the hand comes along. And so on something like that, that's just a nice bread and butter type trade where you kind of study the price action and you start to learn, it's kind of like the behaviors of the stock market, okay? And you can see here that in this case, it actually keeps going, and I'm a big fan of scaling out, so it does keep going. But to me, that 1272 extension, that's that low-hanging fruit. If you just want to get out of your position entirely there, that's fine. But what I'll do typically is I'll get out of at least half, if not more, of my position there. Then I can stop sweating bullets and just kind of let the rest ride a little bit. But that's, again, the low-hanging fruit. Do you use after hours in your charting? So Gene, I don't. It depends. Obviously for futures, I'm looking at the whole nearly 24 hours of trading. I like to know what the kind of the pre-market highs and lows are in a stock, but what I found is that pre-market action kind of screws up some of my indicators because sometimes it may move on only like 1,500 shares of volume. So I chart using the cash session, 8:30 Central to 3 o'clock close Central, but I do like to note where if there was some activity pre-market where it was, for sure. Okay, so that was the first 3 strategies. Now, the first 3 strategies we talked about were all directional, okay? Meaning that If we think it's going to go up, we buy a call. And if we think it's going to go down, we buy a put. Now, the examples I showed were all directional to the upside, but it works exactly the same to the downside. So the next part of this, and this is where it gets a little bit more complicated if you're newer, but how many of you have ever bought a call, like say you bought a call at $3, and then lo and behold, it didn't work and it actually went to 0 and it expired worthless, and you lost all the money that you'd put into that trade. And the first time I did that, I was a little frustrated. I'm like, man, that really, I'd never do that, right? And it's like, man, that really sucks, pardon my French. But what's interesting about that, and someone told me, is like, well, somebody sold you that option, right? Like you bought an out-of-the-money option thinking you were going to make a lot of money. Somebody else sold you that option thinking that you were going to be wrong and that they would make the money, okay? So if you buy an option for $3, okay, and it goes, let's say you buy 10 options at $3 and it goes to 0, okay, well, guess what? You just lost $3,000. Well, but somebody else took the other side of that trade and they sold you those options at $3 and it went to 0, guess what? That money you lost turned into a $3,000 credit in their account, okay? So the good news with this is that you can buy or sell options. Now, the one thing you're going to hear about is when you're selling options, and brokers are very, very cautious around this, because how a lot of people, like in the 1990s or even the 80s, how they would lose a lot of money is they'd sell like naked calls, and then the company would get taken over and they'd just get wiped out. So if you're selling something naked, okay, which means that you don't, so let me put it this way. Let's say that, so Starbucks is a $60 stock, all right? So let's say that you sold the $60 calls for $2 naked, meaning you had no protection, okay? And the next day it was announced that Apple bought them for $100. Well, you'd be hosed, because all of a sudden these calls that you sold for $2 are now worth $40. You just lost, $3,800 per contract. That can hurt. But the thing about it is that you can do spreads, okay? So you can always, 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 always limit your risk. So in this case, if I would have sold the $60 calls on Starbucks for $2, what I would have done was also bought the $65 calls, maybe they're trading at 50 cents, and then what's going to happen is I'm going to get a smaller credit, okay? Now my $2 that I bought minus the 50 cents that I sold. So now my credit is only $1.50, but guess what? If the next day Apple buys Starbucks for $100, my risk is limited to that 65. So I always do spreads, because then you never wake up with egg on your face. You're never going to wake up in a nightmare situation. And it happened too. I mean, it happens all the time when something implodes. Even, when you're trading the VIX and stuff like that too. I always, if I'm short an option, I always do it as a spread, because that way you can sleep at night. There's no reason to ruin your trading career by doing that, okay? So just don't be afraid of shorting options. All the nightmare stories that you hear are because people sold them naked and they didn't do spreads. So, so criteria for, so earlier I was talking about buying options. I always say, look, if you're buying options, give yourself the gift of time, okay? But when you're selling options, it's okay to sell, you can sell options that expire in 3 or 4 days or 10 days, because that way, that premium decay is working in your favor. Every day if an option loses $50 in premium, it's going into your account. So, so I talked earlier about squeezes, right? Well, okay, if there's a squeeze setting up, great. I'm going to, in this case, if it's a bullish trend, I'm going to buy a call. I'm going to look for a directional trade. But guess what? After the squeeze is over, it's going to go back into chop mode. Then I'm going to sell premium. So if it's at resistance, I can sell calls. If it's at support, I can sell puts. Very simple. So here's a good example of this. And these are just simple Keltner channels. So here's Amazon, no squeeze, right? So, it comes up to these upper bands, and then kind of peters out and goes into the lower bands, comes back into the upper bands. So, when it's going to the upper bands, you can sell call credit spreads, all right? When it's coming down in the lower bands, you can sell put credit spreads. Now, why not, why not buy puts here and buy calls here? Just because sometimes you're not even going to get a bounce. It could just hang out here. And if it's hanging out here and you buy a call, you're going to lose money. But if it's hanging out here and you sold a put credit spread, you can still make money. Here's what I love about this. Okay, so in this case, I sold the because this is obviously an older chart, right? In this case, I sold the 240 call, and then I bought the 245 calls protection. That way, in case it took off, my risk is defined. What I love about this is that had the stock just traded sideways, I still would have made my max profit, okay? What I love about credit spreads is they are so forgiving. And once you start understanding credit spreads, a lot of times you won't even go back to ever trading directional again. If your main goal is consistency, then a lot of times credit spreads are your answer to that. If you're bullish on something, instead of buying a call, sell a put credit spread. If you're bearish on something, instead of buying a put, sell a call credit spread. And it just puts the odds in your favor because you can be wrong on the direction of the stock and still make money, which is beautiful. So I typically, if you're familiar with this stuff, a lot of times people will talk about selling options that are 1 standard deviation out or 2 standard deviations out. Okay, so if you sell an option that's 2 standard deviations out, you statistically have a 94% chance of being a winner. What I do not like about that, though, is that typically if you're selling options 2 standard deviations out, you're generally risking 20 to make 1. So in the rare time the stock blows up in your face, you're going to lose 20 times the amount that you risked. So yeah, you're going to feel good most of the time because most of the time it's going to work. But the times that it doesn't work is just a nightmare. And the 1 standard deviations aren't as bad, but typically with a 1 standard deviation, you're risking 5 to make 1. So again, if you have 4 winners and 1 loser, you're kind of at a scratch. I actually like to sell them at the money. So what happens is if you sell an at the money, and all that means is that if Amazon's at 240, then I'm going to sell the at the money call. So I sell the 240 call, and then I buy like the 245 for protection. That way my risk is defined. And typically in this scenario, I'm going to have about a 1-to-1 risk to reward ratio, okay? Now all of a sudden if it doesn't work, not that big of a deal, okay? Because you're risking 1 to make 1, give or take. So that's something that I found is very important. So now the other mistake I made a lot of mistakes when I started out trading, but I would sell credit spreads, and then in my desire for revenge for all the options that I bought that went to 0, I would want the options that I sold to go to 0 so that I could make maximum profit. What I found out, though, is that over time is not a good strategy because you can end up, it's a lot of risk. If you're trying to get that last 10 cents and all of a sudden the stock reverses, all of a sudden, something that was almost at max profit turns into a max loss is ridiculous. So I was to say, look, let's make this easy. If you get to about 70% of your profit target, get out. Okay, what does that mean? It means if you sell a spread for $1, okay, then immediately put on a good tail cancel order just to buy it back at 30 cents. Don't try to get those last few pennies out of it. That's, bulls make money, bears make money, and pigs get slaughtered. And it's the same here. 70% is fine. You sell it for $1, buy it back at 30 cents. You can make a living doing that. All right, so just get out. Don't be a greedy little piggy. Okay, strategy number 5, which may be interesting to do with Tesla tomorrow. I don't know what the news is on Tesla, but I'm watching it as I'm doing this, and it's down $38 a share after hours, trading at $271. So this is called the bad news implied volatility crush. Now what's going to happen on a stock is that so we'll use Tesla as an example. There's going to be panic tomorrow at the open, and during panic and uncertainty, during the SEC sued Musk. My gosh, yeah, I'll look at that after hours. What's going to happen is in the first 3 to 5 minutes of the trading day, the implied volatility on the options is going to explode. Okay, it means it's going to make the options very expensive. And so that's a good time to sell them. So typically, again, so if tomorrow, Tesla opens at $270 and there's a lot of panic, well, you can sell, same thing, the 270, 265 put credit spread, and guess what? It's a 1-to-1 risk-reward ratio. So if it doesn't work, it's not a big deal because you're risking 1 to make 1. It's not like you're risking 20 to make 1. But what the benefit is that as that implied volatility starts to come down, then you start to reap the benefits of it. So here's an example. This is a trade that we did in Baidu, and you can see here that Baidu was at $430, and then after earnings, it gapped down to $360. A huge move. Now here's the options and the implied volatility. They exploded, and you'll see here that even though from here the stock kind of trades sideways, the options that we sold at $10 kind of plummeted down to $4 just because the stock stabilized. And so that's actually pretty common. You'll just see that that's what that it's just once the typically when the stock opens, all the bad news is already in it. Like, oh my God, the news is out. So you wouldn't want to short Tesla in the morning because it's going to open up with all that SEC news already kind of baked in. And obviously it's going to be volatile, but a lot of that stuff is just priced in. Okay. Okay, so that's what we got. If you guys have any other questions, feel free. You can give me an email. Send me an email here at support@simplertrading.com. I did want to let you know that on Tuesday, October 2nd at 7 o'clock Central, I'm going to be doing a 1-hour free training session called Pinpoint Profits, and that'll be on trading options. Now, this link is a little goofy. But if you type in this link just as it is, https://simplertrading.co/pin, and again, I apologize, that's not the easiest link in the world, but it'll take you to the registration page. And again, it's just kind of the, if you've enjoyed these strategies, I've got some other strategies that I'm going to talk about there. Otherwise, hopefully you can start using this stuff. And if you're newer to trading, I love trading options. That's kind of what we do at Simpler Trading. Our whole options track there is really based on that. And most of the tools that we do are in TradeStation, and it just makes it a lot easier. All right. No, you know what, George? It actually, I think we updated it where the input shouldn't be much different. There used to be something based on futures or Forex, but it should be fine, whatever you do there. If you do a credit spread for a volatility crush, aren't you negating IV crush? Well, Daniel, you have a point there. On something like that, typically it can be better to do it naked. For obvious reasons, I think it's not a strategy I would tell anybody that's newer to do. If you're experienced, you've got a larger account and you want to do small naked, then and you can handle that. That's where you get the real edge. But it's just the main thing there is that when you see a big gap down like that, just realizing that it's priced in, and a lot of times it's going to stabilize. So a lot of times people think like, oh, I should buy puts there, and that's the worst thing. So you just want to do the opposite. Do you ever buy debit spreads? Yeah, George, I'm actually a fan of debit spreads. Debit spreads are good. They do limit your potential gains, but they also limit your risk in case the trade doesn't work out. So yeah, I'm a fan of debit spreads as well. All right, guys. Well, thanks for joining us. Don, again, thanks for having me on. It's always a pleasure working with you guys. And for you guys, have fun trading tomorrow. We got Friday, and then enjoy the weekend. And we'll go from there. All right. So thanks again, guys, and we'll see you next time around.
And thank you, John Carter, for your expertise today. I want to remind everybody about our Option Stars Conference in Chicago on October 19th, 2018. One of our presenters is Mr. John Carter. He'll be with us that day to talk about his strategies and to introduce others to his style. If you're interested, here is the link to the Option Stars conference at TradeStation in Chicago. And we look forward to seeing you at the Option Stars conference. So on October 19th, there's a spot for you. in our conference center at the 120 Riverside building in Chicago, where the TradeStation Chicago branch is located. Thank you, John, for everything, and thank you all for your wonderful questions and helping move the conversation along. There's a lot of good traders in this group, I can tell, and we're glad that you came today. Our goal is to make you better traders and to give you the tools that you need to get there. So that's it for me. We'll be back in the morning. We have the morning market briefing 1/2 hour before the New York Stock Exchange opens tomorrow, the TradeStation morning market briefing. Thanks very much. Thanks, John Carter, and thanks, everybody.